Good morning, everyone. This is the live daily market outlook prepared by Windsor Brokers for Friday, 6th of July, 2012. Most of the currencies are in the quiet mode from late hours of yesterday's session and during the overnight after strong movements yesterday, where the single currency suffered heavy losses after European Central Bank's decision to lower its rates by 0.25% to the lowest so far in history at 0.75%, followed also by China and also the Britain Central Bank that also loosened the policy in a space of less less than 1 hour yesterday when all three banks reacted. This is basically signaling a growing level of alarm about the world economy, although suggestions of coordinated action were played down. Of the three, the surprise move was from Beijing, which lowered its lending rate by 31 basis points to 6%, following an interest rate cut just a month ago that also come out of the blue. The European Central Bank cut rates to a record low, set at 0.75%, following a dire run of economic data, but it steered clear of bolder moves such as reviving its government bond buying program or flooding banks with more long-term liquidity. Another important thing that comes to the important release is the U.S. jobs data on farm payrolls, as today is the first Friday of the month, and the whole focus of the markets is on this. The U.S. employers likely quickened the pace of hiring last month, but not enough as seen so far according to the forecast to allay the worries that Europe's debt crisis is shifting the economy into low gear. The Labor Department is expected to say today that non-farm payrolls expanded by approximately 90,000 jobs in June. That is the average forecast for today. That would be stronger than previous months' increase by only 69,000 jobs, but still tightens the wise on the President Obama re-election bid before the November vote. Most economists believe that the job creation in June was too weak to bring down the lofty 8.2% unemployment rate. That might push the Federal Reserve closer to taking new action to lower borrowing costs to encourage companies to increase the hiring. Debt woes have bogged down much of Europe, sending some countries into recession. The Eurozone crisis in turn has dulled economic growth around the world, from China to Brazil. And the survey released on Monday found U.S. manufacturing contracted for the first time in nearly 3 years in June. As said, the main focus is now on today's U.S. data, as most of the instruments are in a rather quiet, I would say, sitting and waiting mode to see what will be the outcome of the U.S. data. However, not much to be expected, as forecasts are quite unified and moving around the 90,000, varying a few thousand up or down, depends from the source. That doesn't give chances for any surprise or any stronger action. Quite a gloomy picture still about the U.S. job market. As said yesterday, Euro dipped, accelerated its losses, and they lost the important supports at 124.40 and 124.00 after initially losing a psychological 125 support, with the more negative tone seen pressuring a pair along with the cable more towards the downside. The dollar against yen remains in the still positive territory, however still unable to break point at 80.00, while dollar appreciated against the Swiss franc and broke briefly above 97, the barrier that might open way for a test of key short-term level at 97.69. The commodities are at the back foot from yesterday, as crude oil gives way of recent strong gains that peaked at 89 yesterday, trading currently at 85, 82 after another round of worrying about current economic situation that keeps the investors more, I would say, negative at this point, and the recent pullback is showing that still strong worries about further slowdown in the world economies that might trigger a further draw in the demand for the energies is still strong. However, the near-term outlook for oil remains positive. More of this we will see in our technical part, as well as gold that is again slightly under pressure and attempting below that was already seen yesterday, brief break below 1600 psychological support, that loss of which might be again weakening the short-term structure for the yellow metal. A quick look at today's calendar before we move to the technical part. The most important things were mentioned. Inflation from Switzerland already released. We don't have yet the result. Minus 0.3 was the forecast. PPI from UK at 8:30. Input forecasted minus 2.10 versus minus 2.5% in May. PPI output minus 0.2%, pardon, unchanged from the previous release. German industrial production is expected to pick up in May, showing expectation showing 0.3 growth compared to a draw of minus 2.2% seen in April. From Canada, building permits due at 12:30. Minus 0.7 improvement from a negative minus 5.2% release of April. Canada unemployment rate, pardon, it's expected to stay unchanged at 7.3%. And finally, that a top release of the day, U.S. non-farm payrolls for June, as set averages 90,000. Our forecast shows 97,000 new jobs seen in June compared to 69,000 of release of May. Slightly better, but as mentioned in our at the beginning of the session, according to the analysts, not enough yet. Unemployment is still seen unchanged at 8.2%. And we're going to move to the technical part. Of course, the top performer yesterday was the single currency, and we will start with the outlook for euro. As we can see, the recent down move of last Friday's peak at 126.90 has bottomed so far to at 123.63 on the sharp decline yesterday after announcement of the European Central Bank lowering rates by 25 basis points, losing important support at 124.40 and 124.00. And now turning focus more towards the downside. Significant was a break below the main bull trend line drawn of 122.87 through 124.06 at 124.30 zone, as well as a loss of 124 level. That turned risk now towards the downside with the 123 psychological and round figure support seen in the focus next ahead of a key short-term barrier support at 122.87 1st of June low. A larger picture sees more risk towards the downside as violation of 122.87 would pave way for a further extension of the longer-term weakness of 2011 peak at 149.38 with the 121.50 low of June 2010 and the 120.00 psychological support seen as the next target in the short term. Near-term outlook, hourly studies are negative. Some corrective action, I would say more consolidative than corrective, was seen within a very narrow range during the overnight session. No any firm signal of a stronger corrective action so far, with 124 as initial resistance still capping the upside ahead of 124.40. I would say nothing significant to expect unless we see a gain of a minimum 125 level that was acting as a stronger support, a break of which would bring some more positive tone in the near-term structure, with the clearance of yesterday's peak at 125.30 zone to provide relief 4-hour structure is firmly negative, although studies still in their extreme downside points, yet no any signal of corrective, meaning that possible further extension would be the likely scenario. As the 20 days moving average crosses below 55 days one and currently standing at 124.90. That level, along with, as mentioned, as previous strong support, should be capping any possible move higher. A similar picture is seen on the cable after upside rejection at 157. Brief breaks higher at 157.21 did not materialize gains, and the subsequent reversal was initially contained at 155.73 zone, with yesterday's fresh weakness extending losses to test the next psychological support at 155.00. That also marks a 50% retracement of 152.67 to 157.76 cent, and just ticks ahead of key near-term support, static support at 154.84, low of 28th of June. Important was break below the ascending bull trend line that was cleared at 155.36. However, the pair is currently in consolidative mode, but dominating negative tone on the lower time frames still sees more potential towards the downside, with the break below 154.84, 154.70 that marks the recent past 3 weeks range floor, expected to trigger further weakness and open 154 as psychological support as next. On the upside, broken trend line at 155.44 still stays intact, the break of which would allow for some stronger corrective action. 155.73, the previous support, will be seen now acting as initial resistance, and as along with the psychological 156.00. Only break above 156.22, yesterday's high, would prevent the pair from further sliding and allow for some stronger recovery. On the hourly chart, 20 days exponential moving average currently at 155.33, along with the broken bull trend line at 155.44, caps the upside. Offers immediate cap ahead of 155, has 73.55 days moving average, also the previous strong support and the consolidative range floor. As at this level is basically expected to limit, along with the 156.00, to limit any potential moves higher. Yet no any firm signals on the lower time frames of any stronger recovery so far, but overextended conditions might be hinting some corrective action, as the pair is in quiet mode, currently awaiting the release of US data. The dollar yen again failed to clear the breakpoint at 80.00, but near-term tone remains in the positive territory, as initial support at approximately 79.80 still holds the downside, ahead of a more significant 79.70 trendline support and the 79.55 yesterday's low, and the short-term range midpoint range of 79.80. As the pair remains within the range, but short-term outlook is still aligned towards the upside, as we have succession of higher lows of 79.12 low of last Friday, with the potential seen for possible attack through 80.00 that will open way towards 80.60, and the signal resumption of short-term recovery of 77.65 1st of June low. As 90 days moving average at 80.64 also caps the upside, but a break above 55 days one might be a good signal of further extension higher. I would say very supportive would be today's break and close above 80.00. That will be signaling a fresh action higher during the next week. A loss of the 79.70 and 79.50 would signal further range trading, while violation of 79.30 higher low of 2nd of July would turn focus towards the lower boundaries of the short-term range at 79.12, 79.00 and 79.90. That marks 200 days moving average, 78.94, pardon, currently 200 days moving average on the daily chart, loss of which would be bearish and turn the focus lower and signal possible end of the corrective phase of 77.65 that peaked so far at 80.61. The dollar Swiss extended its gains, its 1 week strong recovery of 94.61 low of last Friday, clearing all relevant levels. The last one was 96.77, 28th of June, previous high, and briefly testing 97.00, the last barrier en route towards our key short-term resistance at 97.69, 1st of June peak. Positive tone continues to dominate on the lower time frames. However, overextended conditions on the hourly chart might be signaling some corrective action as hourly studies started to point lower of their extreme upside points. Some corrective action might be seen based on this as long as 97.00 caps the immediate action. Initial support stands at 96.77, previous resistance now acting as initial support ahead of 23.6 Fibonacci at 96.54. I would say the risk will be seen on loss of 96.20, 96.00, whereas 20 days moving average 38.2% retracement, and the 95.87 50% retracement, and 55 days exponential moving average loss of 96 zone. I would say these levels would weaken the near-term structure and keep the upside on hold in favor of stronger corrective action. For now, more signals are seen towards the upside, and the clear break above 97.00 expected to open next key barrier at 97.69. As said, crude oil is in the corrective, near-term corrective mode after surging through important, very strong resistance and short-term range top at 87.00, extending gains so far to 88.97. Better seen on the daily chart, just ahead of 89.17, our next static resistance, and the low of 23rd of May 2012. Important was a break above recent range that confirmed the double bottom at 77.54 and 77.27, with 38.2 retracement of the latest down leg from 106.41 to 77.27, seeing potential for further extension higher. At this point, important is that 85.80 previous resistance now acting as support holds the downside, with ideal reversal seen above this level to keep the short-term positive structure of a 77.27 in play for possible extension, further extension and further retracement of the 106.41, 77.27 descent. 4-hour studies are pointing lower as the oil price continues to correct recent strong rallies, with 23.6 retracement seen so far, where the 20 days exponential moving average on 4-hour chart so far holds the downside. More significant support seen at 85.80, previously mentioned the static resistance, loss of which, and 85.28, where is also the previous peak of 29th of June, would be risky for the pair. 38.2% retracement lies at 84.50, and 84.16 is the 55 days exponential moving average, a break of which would delay immediate bulls and allow for a stronger reversal. And finally, the yellow metal, that is again at the back foot. As recall, we mentioned that on the hourly chart, MACD bullish divergence seen, and now is materializing as the pair, the gold action failed to regain initial strong barrier at 16.33, being rejected at 16.24, and subsequent easing, now threatening a 1600 psychological support, as well as 38.2% retracement of the up leg from 1548 to 1624. Currently more negative tone seen on the 1 and the 4 hour charts, pardon, 1 and 4 hour charts, as the price action is currently attacking ascending 55 days exponential moving average with 20 days, one being in the downside sideways movement. Ability to hold above 1600 would be ideal, and would be ideal reversal of the current corrective action for a possible fresh attack higher, but indicators on the 4 hour chart are still pointing lower and approaching their midlines, and seeing risk of further reversal. A loss of 1600 and a more significant 1585 higher low of 2nd of July, as well as 50% retracement would be quite risky, as this might bring a focus again towards the downside, and critical support zone at first static support at 1550, and then critical support zone at 1530, 1520, and 1500, loss of which would be bearish for the yellow metal and will be signal extension of the longer term downtrend from 2011 peak at 1920. That also marks the historical high of gold. Loss of set 15, 20, 30 and 1500, and another static support at 1478 would be focusing 150 days moving average on the weekly chart at 1400. In case of a break, for now 100 days moving average holds the recent short-term price action of 1526 with the break below this level, which is currently at 1543, would further weaken the structure and allow for test of the critical support zone 1530 and 1520. Thank you all for attending and being with us. This is the end of today's session. Just would like to inform you that we are back on Monday at the same time at 7:00 GMT. Until then, wish you a nice day and a nice and relaxing weekend. Good luck.